Most new investors think dividends are free money, but they're wrong. That mistake alone could cost you tens of thousands over decades. Today, I'll show you the right order to invest your money to actually make your dividends matter. What if I told you the dividend stocks you love are not the first thing you should buy with your money? Stick with me and I'll break it down. Early investors see a big dividend and think, more yield equals more money. Sounds logical, right? But here's the truth. An 8% dividend looks amazing until the company cuts it next quarter. Suddenly, that money disappears. High dividends aren't always a sign of strength. Sometimes they're a red flag: declining revenue, financial trouble, or payouts the company can't sustain. The smarter approach: focus on stable, growing dividends. Even a modest 3 to 5% yield that keeps growing compounds into far more money over time than a risky 8% that vanishes. Remember, steady wins the dividend race. So before you chase that next high dividend, ask yourself, can this company really deliver this payout long term? Before chasing dividends, you need to follow this order, because skipping steps is how most investors stall their progress. Step 1. Build an emergency fund. This comes first, always. You want 3 to 6 months of living expenses set aside in cash. Why? Because if an emergency hits and your money is locked in investments, you'll be forced to sell at the worst possible time. An emergency fund protects your investments from you. Step 2. Eliminate high-interest debt. Credit cards and high-interest loans can quietly destroy your returns. If you're paying 18% or 20% in interest, no dividend strategy can realistically outperform that. Paying off high-interest debt is a guaranteed return. Step 3. Maximize tax-advantaged accounts. This is where investing really starts to compound. In the US, that means accounts like a 401k or Roth IRA. In Canada, think RRSP and TFSA. These accounts shield your growth from taxes, and tax savings can outperform stock picking over decades. Step 4. Invest in total market index funds. Before focusing on income, build a strong growth foundation. Broad market ETFs like VTI, VOO, XIU, or VUN give you instant diversification and long-term market growth. This is how you grow your capital efficiently. Step 5. Add dividend stocks or dividend ETFs. Only after everything above is covered. Dividends work best when they're built on top of a solid financial base, not used as a shortcut. At this stage, dividends become a tool for income, stability, and long-term cash flow. The key lesson is simple. Dividends are powerful, but only in the right order. Build the foundation first, then let dividends do what they're meant to do. What is a sustainable dividend investing? What to look for? Dividend growth versus high yield. What's better? Stop chasing the highest yield. The key isn't the number on the screen, it's how reliably it grows. Focus on companies with growing dividends. Why? Because a dividend that rises year after year compounds faster than any one-time high payout. Check the payout ratio. That's the percentage of earnings paid as dividends. Low ratios mean the company can sustain and increase dividends even if earnings dip. Next, strong earnings growth is the engine behind reliable dividends. Companies that consistently grow profits can fund bigger payouts without risking financial trouble. A stock with a high yield but no growth? Risky. A stock with growing dividends, low payout ratios, and strong earnings? Sustainable income that compounds over time. Remember, dividends are a tool, not a shortcut. Focus on growth, safety, and sustainability, and let compounding do the heavy lifting. Taxes and account types, US and Canada. Dividends aren't all created equal, and taxes can eat your returns if you're not careful. In the US, there's a big difference between qualified dividends and ordinary dividends. Qualified dividends are taxed at low capital gains rates. Ordinary dividends, regular income rates, higher taxes, less compounding. In Canada, it's eligible versus other dividends. Eligible dividends get a tax credit, meaning you keep more of your money. Other dividends taxed less favorably. That's why owning dividends in the right account matters. TFSA, Roth IRA, or 401k, tax-free or tax-deferred growth. RRSP, same thing in Canada. Put your dividend payers in the accounts that protect your money, not the ones that give it to the government. Even small tax differences compound over time. A 2 to 3% drag every year can turn 100K into 50K less in 20 years if you're not careful. Taxes can quietly destroy the power of dividend growth. Remember, dividends are powerful, but only if you own them in the right accounts. Know your tax rules, choose wisely, and let compounding do the heavy lifting. Here is a bonus strategy: reinvest dividends. When you reinvest dividends, you supercharge compounding. Every dividend you reinvest buys more shares. Those shares then generate their own dividends. It's a snowball effect, growing bigger and faster over time. The real magic happens early. Reinvesting dividends in the first years compounds faster than any extra contribution you could make later. Even small dividends reinvested consistently can turn a modest portfolio into a serious income generator over decades. That's why top investors focus on total return, not just yield. The mistake? Taking dividends as cash too early. It feels good now, but it slows down long-term growth. Let your money stay invested and work harder for you. Remember, reinvest dividends, let compounding do the heavy lifting, and watch your wealth snowball. Small actions today can create massive growth tomorrow. Like and share if this helped you. Comment where you're at in your investing journey. Subscribe for more investing clarity.